China, the world's #2 economy, is currently grappling with a once-in-a-generation housing crisis, which, if mismanaged, could have an impact even greater and more far-reaching than the global financial crisis. In a recently published Oxford Economics article, the report suggested that if China saw the same drop in residential investments that the US saw in the early 2000s, China's overall growth could drop from 6% per annum to 1% per annum by 2024. For an economy the size of China, this would be an earthquake for global markets and would have profound economic and geopolitical implications for the rising power, particularly in relation to its competition with the United States. Even a less severe downturn in the Chinese housing market would result in a drop to less than 3% of growth, according to the research firm. And the downturn in the housing market looks very real. In October, for the second month in a row, triggered of course by the Evergrande crisis, housing prices in China have dropped. And this crisis is much bigger than Evergrande. It touches on the entire Chinese housing market and the Chinese growth model, and how it's resolved over the following months is going to change the world as we know it. What's up guys, welcome to China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony, and in this special episode I'm going to tell you guys what exactly is the deal with this Evergrande crisis, how did we get to this housing crisis in China, and how it affects you and the world. Okay, let's jump in. Let's start in the beginning. The Chinese housing sector was effectively privatized in the 1990s during the so-called Danwei reform era. This led to an explosion in building construction, and house prices skyrocketed. Because there was so much pent-up demand for quality homes after decades of demand being suppressed through communism, the price explosion was not a bubble, but rather a manifestation of real demand. From the mid-90s through to around 2010, homeowners saw huge capital gains from their properties, and property developers expanded at breakneck speeds, making billions in profits. However, around 2010, the prices of housing became detached from real underlying demand, and the housing sector moved into bubble territory. This bubble has been sustained for years, due primarily to moral hazard, the belief amongst buyers and developers alike that the government will not let the housing market collapse or even allow more than a modest price correction. This is combined with a household preference for housing investment, which has outperformed equities investments for decades. Today, real estate represents approximately 70 to 80% of Chinese urban household wealth. Also, over the last 10 years, household debt in China went from some of the lowest levels in the world to some of the highest levels in the world, with household debt to income ratios in China shooting past US household levels back in 2016. During the same time, and due to the same underlying factors, property developers became increasingly over-leveraged, recklessly diversifying into other businesses for which they had no specialization or experience. Okay, so far households are buying into a bubble and have been for well over a decade, and developers are incredibly over-leveraged. Is that everything? No, not quite. There is one other aspect to all of this. Also, since about 2010, local governments, in order to meet politically set growth targets and restrained by fiscal restrictions, turned to the sale of land as a major source of revenue. And I mean a major source. Last year, revenue from land sales was approximately 1.3 trillion US dollars. This is only slightly less than total income tax revenue for local governments, which was around 1.5 trillion US dollars. For the last decade or so, local governments have become very reliant on land sales to fund their operations, including infrastructure construction to maintain growth and employment, which means they have a powerful economic and political incentive to prevent house prices from dropping, thus reinforcing the moral hazard that sustains the bubble. By 2015, it looked like the housing market was finally going to undergo a much-needed correction. However, regulators and local government officials got cold feet and turned to credit to bring the housing market back to life. However, by around 2018, central government regulators finally were able to convince top policymakers in the capital that systemic financial risk could not be ignored any longer, and that deleveraging across the entire debt-ridden Chinese economy, including and especially in the property development market, had to happen. Restrictions were put on lenders to lend. However, the bloated property developers just turned to new forms of financing their operations. For example, selling apartments to keen buyers, sometimes years in advance, selling low-quality financial products to employees, and writing what are essentially IOUs to third-party suppliers. Then in 2020, regulators put borrowing restrictions directly on property developers with the introduction of the so-called 3 red lines policy. And this was a serious blow to many developers, including most infamously China Evergrande Group, as they now could no longer access cheap capital and as such could not meet their obligations to lenders. Late this year, Evergrande shocked the entire market by missing a payment, triggering a wider crisis in the over-bloated property sector, as all actors realized that maybe the property sector could indeed crash and that property developers were not as safe as had been assumed to pour money into. Now the question is, will Beijing stay the course and finally force deleveraging, or once again get cold feet and loosen restrictions on developers to get more growth again? Also, if it is the former, how well will they manage it? Either we are going to see regulators successfully transition the economy through what would be a very painful transition period to a slower Chinese growth model, but one that is more sustainable, or Beijing will get cold feet, like I said, turn back the credit taps, and we'll have another crisis and an even bigger crisis on our hands in a few years. And even in the unlikely event that the deleveraging transition is managed masterfully with no short-term pain, it will still mean slower growth for China going forward, and this will have profound effects for China's role in the world and its competition with the United States, as well as for many countries and companies that have relied on Chinese growth for years. How this Chinese property crisis develops over the following weeks and months will have a huge impact not only on its economy, but the economy of the entire world. And we'll be following these updates as they happen with the most up-to-date news and analysis here on China Update. So if you're interested in that sort of up-to-date analysis, maybe consider subscribing. If you enjoyed the video, don't forget to hit that like button. It really is a huge help for a small YouTube channel. Otherwise, I simply cannot grow. So if you do get some value, please hit that like button. Thank you for watching. I'll see you guys next time.